All right, today we're hunting a ghost, but not a spooky one. We're talking about the invisible, multi-trillion-dollar assets that really define our modern economy. We're diving into the code, the brands, and the ideas that drive so much value, all governed by one powerful accounting rule, IAS 38.
So think about it for a second. Where does a tech giant's value really come from? When you look at the biggest companies on the planet, it's almost never their factories or their buildings. Their true value is in stuff you can't even touch, their software, their patents, their brand recognition. And that creates this huge puzzle for accountants. How in the world do you put a price on something you can't even see? So here's how we're going to break it all down. First, we'll look at that trillion-dollar ghost, that gap between market price and physical stuff. Then, we'll nail down what intangible actually means to an accountant. We'll see how these things get on the books and tackle the huge split between R&D. Then we'll get modern, looking at crypto and the cloud, and we'll finish up by looking at the massive conflict between real-world value and the accounting rulebook. Okay, so this gap between what the stock market says a company is worth and what the financial statements say its actual physical assets are worth, that's what we're calling the trillion-dollar ghost. It's all this value that's definitely there, but it's just not officially recorded. And this isn't some mistake. It's what happens when you apply accounting rules from an industrial age to our digital world. Understanding this ghost is absolutely key to understanding business today.
To make sense of all this, we've got to start speaking the language of the accountants. They have a very specific name for all this valuable, invisible stuff. So let's get the official definition, straight from the source itself, International Accounting Standard 38.
There it is. It's short, but man, every single word in there packs a punch. Identifiable means you can separate it from the company, sell it or license it. Non-monetary just means it's not cash. And then there's the big one, without physical substance. It's pure value existing only as an idea, a legal right, or a bit of knowledge.
Okay, so that definition gets broken down into 3 key tests. Anything that wants to be called an intangible asset has to pass all 3. First, is it identifiable? Again, can you sell it, or does it come from a contract, like a patent? Second, does the company have control over it? This is usually a legal thing, like a copyright that stops other people from just copying it. And third, will it generate future economic benefits? I mean, plain and simple, is this thing going to make the company money in the future?
So, let's say you've got something that passes those 3 tests. You'd think you're good to go, right? Well, not so fast. Just meeting the definition isn't enough to get it onto the balance sheet. It has to clear 2 more really strict hurdles. These are called the recognition criteria, and this is where the rules start to get really tough, because it's all about being certain.
What's fascinating is that it all boils down to 2 pretty simple questions. First, is it probable? And that's the key word, not just possible, but likely that this asset will bring in cash. And second, can we measure what it costs to get it reliably? If you just bought a patent from someone for cash, that's easy. But what if you're building it yourself, inside the company? Well, that's where things get really complicated, and it leads us right into our next big topic.
Now this, right here, is one of the most important and honestly most debated parts of IAS 38. When a company spends millions, maybe billions, developing some new product, is that money creating a valuable asset? Or is it just a cost of doing business that year? Well, the standard forces a very, very sharp line in the sand. The rules basically split innovation into 2 phases. First, you've got the research phase. This is all the early, blue sky thinking, searching for new knowledge. Think about a pharmaceutical company testing a dozen different compounds to see if any of them might fight a disease. All of that spending is an expense. It hits the income statement and vanishes. But then, the development phase starts when they've picked one of those compounds and they begin the formal process of making a pill they can actually sell. That spending can become an asset, but only if they can check off a whole list of boxes proving it's going to work and make money.
And this quote just says it all. I mean, look how blunt it is. This is not a suggestion, it's an absolute command. You cannot, under any circumstances, count costs from the research phase as an asset. Now, why is that? It's because at that early stage, any future payoff is just way too uncertain. So, to protect investors reading a balance sheet, the rulemakers chose verifiable numbers over speculative dreams every single time.
So we've seen how the rulebook tries to draw these really clear conservative lines, even for something as messy as innovation. But what happens when technology completely reinvents what an asset even is? Let's take a look at how these decades-old principles handle some 21st century tech.
I mean, take cryptocurrency. It's digital, It clearly has value. But what is it from an accountant's point of view? Is it cash, a financial investment, or is it something else? This wasn't just a fun thought experiment. Companies holding crypto needed a real answer, and they found it right inside IAS 38.
So the official accounting bodies, they basically worked through this with a process of elimination. They asked, is it cash? Nope, it's not a universally accepted currency. Okay, is it a financial asset? No again, because it doesn't give you a contractual right to get cash from somebody else. So what's left? Well, it's identifiable, it's non-monetary, and it has no physical substance. It fits the definition of an intangible asset perfectly. So, for accounting purposes, crypto is an intangible asset, and it gets all the same strict rules we've been talking about.
And what about all the software we use in the cloud? If your company signs a 3-year deal for a software-as-a-service platform, have you actually bought an asset? Well, the deciding factor comes back to that key principle from before, control. It's kind of like renting a fully furnished apartment versus owning a house. With SaaS, you're just renting. You can use everything, but you can't change the underlying code. The supplier has all the control. So, since the customer doesn't control the software, they haven't bought an asset. They're just paying for a service.
And this brings us to our final and maybe the most mind-bending part of this whole story. We've seen what the rules do recognize, but now let's look at what they explicitly, on purpose, leave out. And we're talking about some of the biggest ghosts in the entire economy.
So get this, a company can spend decades and billions of dollars building one of the most recognizable and valuable brands in the entire world. And according to IAS 38, the value of that brand on its own balance sheet is zero, nothing. The same thing goes for a super loyal customer list that it built from scratch. These things are explicitly forbidden from being recognized as assets if a company creates them itself.
And here is the logic behind that rule, which seems crazy at first. How would you reliably measure just the cost of building the brand? Was it the marketing budget from this year? Was it the product designer's salaries from 5 years ago? It's impossible. The standard basically argues you can't separate the cost of building a brand from the cost of just running the business day to day. So, to make sure the numbers are rock solid and reliable, it makes a huge trade-off. It chooses to sacrifice a complete picture of value.
All right, so let's boil all this down. What are the key takeaways? First, intangible assets are those invisible drivers of value. Second, to get on the books, they have to pass a whole bunch of strict tests. Third, there's that hard line. Research costs are always an expense, while development costs might become an asset. Fourth, and this is a big one, some of the most valuable things a company builds itself, like its own brand, are never recognized. And it all comes down to this core principle. The balance sheet is designed to be reliable, even if that means it isn't a complete picture of a company's real worth.
And that leaves us with one last big question to think about. In an economy that's more and more dominated by ideas and data and brands, are the accounting rules we built for a physical world still doing the job? As that gap between market value and book value gets wider and wider, it really forces us to ask, do we need to find a new way to account for these trillion-dollar ghosts?